Good morning and welcome to another live technical analysis. Starting off with the euro against the US dollar. We're going to be removing our support and resistance levels, and we're going to be determining new S and R levels together on this live. So we are currently on the 4-hour time frame. As a small reminder, we like to use the 4-hour time frame for a medium to slightly longer term outlook rather than using the 30-minute or 15-minute, which could easily be changed and broken throughout this live stream. As such, a 4-hour chart may be more useful for those of you watching at home at a later time later on today. Now, in terms of financial releases, we have the preliminary consumer confidence for the Eurozone, and we have the FOMC's meeting minutes, which are due to release later on today. Both events could impact the euro against the dollar, and essentially, the FOMC meeting minutes could impact the dollar JPY, cable, dollar against the CAD, Aussie, Kiwi, etc., USD, and all potentially as well. Now, looking at the euro against the US dollar, first of all, we're going to be drawing an upwards moving trend line starting from this bullish candle extended upwards. It is validated because it has a touch from this bearish candle's wick, and once again on this two bullish candles moving in an upwards fashion, as such validating our upwards moving trend line. Now, one could say this appears to be moving in a slightly upwards fashion based on the upwards moving trend line, yet some divergence from the RSI is noted, but this could be a small correction to the mid-range of the Bollinger Bands before continuing higher. It's tilted towards the upside, and as such, we could maintain a bullish outlook for the particular pair, at least for today. Now, in terms of support and resistance, I'm going to be taking this previous swing high, this higher low at 1.07655. So rounding it up, 1 point, and that would be our S1. So we have S1 here. Found support, failed to break and moved higher. Resistance, this high here, failed to break above and moved lower. So this is S1 and R1. I'll be changing the colors in just a minute. S2 could be at the beginning of this upwards moving trend line. And by placing S2 at this level, you can see it's validated not once, not twice, not thrice, but on 5 separate occasions. Therefore, heavy support at 1.07. And it is far enough from S1 so that if it does move lower, so let's say the FOMC's meeting minutes are predominantly hawkish in nature, which is a view we continue to maintain. So essentially implying that the Fed may keep rates higher for longer, thus cutting back on the market's expectations of now 4 rate cuts this year, which could provide some support for the dollar. So let's say those are hawkish. Those comments, the meeting minutes are hawkish. It would break below S1 potentially. And then if I place this 2 that close to S1, it could easily be broken. Whereas now, if it does break below S1, the next potential target could be S2 at 1.07. Now, for S3, we'd have to go further back in time, find an old support level or resistance to support. And I can see at this level here. So once again, had I placed it here, too close to S2. So by placing it at this higher low, we're giving some distance between S2 and S3. So in the event that it does break S2, we have S3, which is further away. So next potential target. And let's just round this up and fix our text labels together. 1.0620. That's R3, not S2. So 1.0620, that's S3. S2 we've said is 1.07. And then we already have S1. We're going to be looking at resistance. Also worthy noting is BOE Bailey, who cut back on expectations of perhaps rate cuts by implying that the recession in the UK is a shallow recession. A view I personally don't agree with, but those comments may have alleviated some downward pressures on cable. Resistance, we're taking this old high. Note how the price action came up to this particular level, and after failing to break above, moved lower, strong movement lower. Now, if we had extended this trend line, you can see it's broken above, came back down, but we have an upwards moving trend line. By the way, this trend line was formed roughly, let's say, on the 2nd of January 2024, broken. So it appears that the downwards momentum on the euro might have come to an end at this point here. So it's making new higher lows and higher highs, potentially implying that this downwards motion that we had seen appears to have come to an end. But that could easily change with the FOMC's meeting minutes due out later on today. For now, however, based on a technical point of view, we have R1 at 1.0820. So let's just change the text labels as well. 1.0820, that would be RR1. We're taking this recent high, failed to break above, move slightly lower. Overall, I would maintain a slightly bullish outlook for the pair, yet I'm slightly concerned with the RSI being near 50, which could imply a neutral market sentiment, so stay in between S1 and R1. Nevertheless, if our upwards moving trend line continues to be validated, we would still maintain our bullish outlook. For that to be broken, it would have to break below our upwards moving trend line. So let's say for our candle breaks below and opens lower, then I would switch towards a sideways bias between S1 and R1. Whereas if it stays above, so it comes back down and then continues higher, we would maintain our bullish outlook. So R2 is 1.0890. Now for R3, continuing with the same concept that we had for our support levels, we're looking for something that was higher, but not too close to our 2, which appears to have been at this old high. Despite the wicks, the candles closed below the resistance level, so it may have taken some liquidity before continuing on its descent. As such, this could be a valid resistance level. Now, our resistance for R3 for this particular pair is 1.0985, so we're rounding it slightly up. Let's make sure that this actually coincides with the price action. So zooming in, we have two touches, but if I want to be slightly more accurate, I'm taking this bullish and bearish candle. So if we go back, it's 1.0982. So that's a bit better in my opinion. So this would be my R3. Let's just change the text label as well, 1.0982. Let's be slightly more precise. So I have R1, R2, R3, and then I have my support levels noted below. Feel free to copy these onto your own chart, whichever platform you're using, and then simply watch the price action. Now, the RSI is a bit concerning. Let's add the OBV as well, which is the on-balance volume. Essentially, what this is perhaps the direction of the trend. If it's moving in upwards fashion, then we would expect OBV to be moving higher and higher. Whereas if there's a divergence, so if this was moving lower but this was moving higher and higher, then it could have implied that it may have been optimal for a buy entry, perhaps. Or if it's moving lower, excuse me, but if it's moving higher, yet OBV is moving lower and lower, could be a potential short position. Overall, OBV moves slightly lower. If it does come back up and breaks this point here, then we would maintain our bullish outlook. For now, slight concern with our RSI, but as long as our upwards moving trend line continues to be validated, I would maintain a bullish outlook for the particular pair up until the release of the FOMC's meeting minutes. Moving on to the dollar against the JPY. Now, we've placed S1 at 150. So this would be a psychological support level. Now, one might be wondering, well, why won't you place your S1 level slightly lower? Well, in this particular scenario, 150 is a very nice big figure. It's 150. There's a psychological impact in trading as well. So 150 could be determined as a key support or resistance level. Now, yes, I do agree that perhaps it could have been slightly lower, but it is 150. So it's a psychological impact. It's fluctuating around this level. So I place more emphasis on my S2, S3, and then on my R1 rather than S1. If it manages to break above S1 and aim for R2, that would be bullish. If it stays between R1 and S1, so staying between this range, we could maintain a sideways bias. But if we want to be slightly more accurate, it could put it at 149.85, although 150 is also valid. So 149 150.85 for S1. And then very close to that is 150.80, which is R1. So if you'd like a sideways channel, this would be it based on the narrowing of the Bollinger Bands. So widening low market volatility, RSI 51. As such, sideways bias between S1 and R1. I wouldn't maintain a bullish outlook for the particular pair, mainly because Japan's economy has entered recession territory. So there's concern that the bank may be facing heavier pressure to act. So when we're talking about acting, perhaps abandoning the rules monetary policy, or perhaps adopting an even more hawkish stance, which could potentially support the JPY. Now, for a sideways bias to continue, it will have to stay between S1 and R1, but that is very close to each other. As such, for a bearish outlook, it would have to break below S2. Simply breaking below S1 would not be sufficient. It would have to break below S2 as well and then take aim for S3 at 146.80. Whereas for a bullish outlook, simply breaking above, well, we would have said simply breaking above R1 at a prior point, but since R1 is fairly close to the current price action, let's go back and let's readjust our R2 level. Now, note just by looking at the price action, I'm taking this high here. Note the multiple candles that failed to break above and then moved lower, so that's a resistance level for me. 151.82. And then we have to readjust R3 as well. But R3 is in a resistance level or not. R3, all-time high. No, R3 is not all-time high. So that's an extrapolated resistance level. So that means I take the distance between S2 and S3 to keep my consistency the same. So 1,944, so 194 pips. 194, 153.80. So that would be my R3. And there you have it, resistance and support. R1, R2, R3, and then you have S1, S2, and S3. So the distance between R2 is relatively equal between S2 and S3. So we're maintaining that. For a bullish outlook, it would have to break above R1, if not R2 as well. Same scenario for a bearish outlook, breaking below S1, if not S2 as well, and then taking aim for S3. Same scenario for a bullish outlook, taking aim for 153.80. In terms of financial releases, we have the manufacturing and services PMI figures for Japan throughout tomorrow. I would place more of an emphasis on the manufacturing PMI figure for Japan. So if it comes in better than expected, might provide some support for the JPY. Although if it does come better than expected, that could imply that the bank's monetary policy of it being ultra loose, so negative interest rate territory, might be working, and as such, less pressure on the bank to abandon that policy, which could actually weaken the JPY. The JPY is a very interesting FX pair. Moving on to cable. So it's broken above R1, failed to break above R2, so this immediately would become S1. And then I'll keep S2 and S3 the same. I'll remove old S3. Then I'd need my new R3. And let's look at per point in time. This looks very nice. Found resistance, wicked up, failed to break above, moved lower. So that's my R3. Now, one could say yes, it's relatively far away from R2, but look at S1 and S2 and then S2 and S3. So that's actually all right. It's consistent with the other support and resistance levels. Then let's just change the text label. Now, RSI 50, sideways bias between S1 and R1, narrowing of the Bollinger Bands as well. Also imply no market volatility, and as such could remain confined between S1 and R1. In terms of monetary policy, the comments made by Governor Bailey could be slightly hawkish in nature, but it wouldn't be extremely bullish. Instead, it could alleviate some downward pressures on the British pound, which is my staying between S1 and R1. I've got S1, so this becomes S2. Hold S2 becomes S3. Then for S1, 1.2580. That's my S1. Staying between S1 and R1, so that's my sideways bias. Breaks above R1, bullish outlook. Now note that there's also formation of an upwards moving trend line, not too steep, so it could be a gradual incremental increase in the strengthening of the British pound. So it continues to validate this upwards moving trend line. It could maintain a bullish outlook as long as it does break above R1. If it does not, sideways. Bearish outlook, I don't see that case yet, but it breaks below S1. Next target S2, 1.2445. Dollar CAD staying between our support and resistance levels, relatively sideways bias, 56 on the RSI, so implying a neutral market sentiment. Now, if we add the, we're not going to be adding the CCI. So have S1, S2, S3, staying the same. We could look at OBV as well, since we mentioned that before. That might be the new thing that we do today. Unbalanced volume, so it's assigned. So I wouldn't be bullish, I'd stay sideways. Higher highs and higher lows. RSI, but it's not moving in an upwards direction. Note how it came back down, staying between here. If it was up here, I would be bullish. If it was down here, I would be bearish. But staying around here, that's a sideways bias for me. Between S1 and R1, I wouldn't say there's an upwards moving trend line. You could, but based on what we're seeing, I wouldn't say that's bullish. I'd say max could come. It could potentially come up to R1, then fail to break above and staying between S1 and R1. Aussie appears to be strengthening. Let's move at the daily. So note the consecutive green days. So I'd actually maintain a bullish outlook for the Aussie, despite the RSI being at 57. So we contradict ourselves with the RSI because 57 was the same for CAD. But in this case, the overall, I'd say, intermediate direction is upwards. You've got higher highs and higher lows. So it might be a 57, yeah, but it could be a small market correction. But it's validating an upwards moving trend line. If you compare that to the CAD, which came back down from R1, I'd say this is a more stronger signal or indicator that the Aussie is moving in an upwards fashion. Also note, Australia's PMI figures as well are due out tomorrow, so if they come in better than expected, could potentially provide more support for the Australian dollar. Now let's just switch. So this becomes S2. Old S2 becomes S3. And then S1, 0.6475. We have R1, R2, and R3, so those are not changing. $4.75, so that's minus 1. Would maintain a bullish outlook as long as it continues to validate our upwards moving trend line. If it does not, sideways bias between S1 and R1. So this is R3, then that's R2. Oil. Now, oil appears to have taken a dip today, which is slightly surprising considering the tensions in the Red Sea continue to occur. So you've got new strikes by Houthi rebels on shipping vessels, which in theory should have provided some support for oil prices. But nevertheless, the RSI is actually below 40, which implies a bearish market sentiment. Now, if it fails to break below us, if it breaks below S1, I would switch towards a bearish outlook. For now, I'd maintain a sideways bias between S1 and R1 as long as this S1 level continues to hold. If it does not, immediately switch towards a bearish outlook, taking aim for S2, 71.55. We're going to be looking at gold as well, but slightly later on. I think what most of you might like is NVIDIA. Okay, 794.50. NVIDIA has earnings later on today. Now, let's remove that. I am keeping R1, R2, R3. I might have to readjust my S1, S2, and S3 levels. But I wouldn't really adjust my S2. I'd simply adjust my S1. I'd bring my S1 slightly higher, so closing that gap between S1 and R1. I keep S2 just in case the earnings are way worse than what is currently expected. So, in terms of earnings per share and revenue, the company is expected to do better than last quarter. So, higher EPS, higher revenue as well. Now, personally, based on what we're seeing with the AI boom, Google's new AI help bot, etc., the announcement at CES in January, I'm expecting personally that Nvidia might actually meet those expectations, if not better. But you never know. If by some rare chance, well, not really rare, but if they don't meet those expectations, the company's stock price could be heavily weighed, as there might be concerns about their growth. I would personally compare the same quarter's earnings for this time period last year. If I'm not mistaken, EPS was around 80 cents, and then revenue in comparison to the same quarter last year grew by, I'd say, if I'm not mistaken, around 12 billion, which is insane. So it's very interesting in terms of the company's path. So earnings today could garner significant interest from everyone. It could also be a benchmark. If they underperform, it could weigh on the company's stock price, the Nasdaq, the Dow Jones, and the S&P 500, despite them not being that tech heavy. When I'm talking about the Dow Jones 30 and S&P 500, the Nasdaq could definitely be impacted if Nvidia dips. From a technical point of view, RSI is 63, so it's still bullish, but the bullish sentiment appears to be fading. It was above 70, so implying it was overbought, as we had said last week, coming back down lower. So I'd maintain a bearish outlook up until S1. I think S1 might be a turning point for the company in addition to their earnings. Now, please note their earnings will be released after the market closes, so the impact might be seen tomorrow. We're keeping S1 629.90, S2 504.3, S3 391.70, R1 746.10, and I actually need to change those text labels. 391.70, that's my S3, 746.10. So that's my R1. Now, from a technical point of view, bearish up until S1. So that would be my first target. Next target being S2. If it breaks below S1, bearish outlook for the company. Now, of course, it will depend on their earnings, which are going to be released after the market closes. Lower than expected, would not be surprised to see the company actually dip down to S2, if not S3 as well. So that might be interesting. But if they come in better than expected, could perhaps break above R1, aim for R2, if not going for R3 at 955. So Nvidia's earnings are the ones to watch today. In terms of other earnings, we had Walmart yesterday, which exceeded market expectations, so potentially providing some support for the company's stock price as well. And do we have Walmart open, or do we need to chart it ourselves? ExxonMobil sideways between S1 and R1. Concerns about Venezuela attacking Guyana, and note that ExxonMobil has a heavy investment in Guyana, offshore oil rigs, etc. So if those tensions escalate, could weigh on ExxonMobil's stock price. S1 and R1, those are sideways bias, staying between there. Then you have S2 and S3, R1, R2, and R3. You can have a look, chart this as well, see what happens. We've done Nvidia, haven't done Tesla, staying between S1 and R1. Airbus actually came back lower. Might be slightly bearish on Airbus. Let's look at Boeing, which has been out of the news for quite a while now. IBM, if it breaks below this R1 we had placed before, it could come and fill this gap. So taking in for 176.10. Let's see. Boeing, staying between S1 and R1. Bad outlook for the company. Gold, let's do gold, which we had said we're going to be doing. This would be -1. So resistance turns to support, 214. So this would be my R2, 2042.50. R3, R2, 2075, and then let's go back. Too close, all-time high. 2135 or 2136 all-time high figure of gold. Yeah, it's very far away, but that's the data we have. Anything else would have been simply too close. The price action, well, to the other resistance levels. So this is R1, 2136, and then 2014, but this becomes S2, so that means I'll be changing old S3. And then 2014 for S1. If you're interested in getting something a bit more fresh throughout the day, we do have an X account at IronFX Global, so that might be worth following if you're interested. In terms of gold, now technical analysis, upwards moving trend line, we've got two. So this is an upwards moving trend line, but we would like to see another third touch for that to be validated. RSI 64, gradual increase, higher highs, higher lows, bullish outlook on the precious metal. But once again, that could easily change with the FOMC's meeting minutes, where if they're hawkish and the dollar strengthens, gold breaking below S1, taking aim for S2, 1,972. So we've got an upwards moving trend line. Bollinger Band is tilted to the upside. RSI higher. So all point towards a bullish outlook for the precious metal. There's also tensions in Asia between China and Taiwan, which could actually funnel some safe haven inflows into the precious metal as well. So that might be providing some boost for gold today. Let's look at the S&P 500. S1 4,950, S2 4,800, S3 4,660. In terms of resistance, you've got 5,100, R2 5,250, R3 5,400. The breaking of our upwards moving trend line might signify that the bulls may be losing momentum. 55 RSI, sideways, no longer bullish. Breaks below S1, will switch towards a bearish outlook. Look at the Nasdaq as well, taking aim for S1, 17,165, breaking over upwards moving trend line, signifying that perhaps the bulls may have lost control of the index. If it breaks below S1, continuing our bearish outlook down to S2. What else should we have a look at? Then the Aussie, we could do the Kiwi as well. So this is resistance turn to support at S1. Now, in terms of R2, in terms of R1, could have R1 here. Let me just show you as well what I'm looking at, this old swing low. But it might be more prudent. Multiple touches might be more significant of a resistance level, and then we can readjust this slightly higher, so giving it some space to breathe in the event that R1 is broken. We could also bring R2 slightly lower, take this old higher low. Let's see, so I've got R1, R2, R3. If I place R3 up here, that's a bit too far away from the current, from my R2. If I place R2 here, I've got multiple touches validating this as a resistance turn to support. Broke down below, broke down above, closed and opened, failed to break up, so came back up, did not manage to, opened, tried to wake up, did not, came back down. So that's my R3. So simply taking you through my thought process for our resistance level at R3. Some of you may agree, some of you may disagree. That's fair. We're all entitled to an opinion. S2 0.6050. So that's my S2. And then old S2 becomes S3. So we're taking the text label of our old S3. Let's see. 0.6315. Switch this to red. 0.6268. 628, yes, or we could do 6270. 6270 actually not that nice. 628. So that's my R2. For R1, 0.621550. 0.6215 as R1. So I've got R1, S1, S2, upwards moving trend line. Validated. One could even say this is an upwards moving channel. Just need 2 touches. So it's broken, so not really that valid, but could be a market correction. But nevertheless, perhaps an upward moving trend line is more prudent. 65 at RSI. Bullish market sentiment for the New Zealand dollar against the US dollar. As long as it breaks above S1. If it corrects lower to S1, it would still validate our upward moving trend line. But if it does break below S1 and our upward moving trend line, switch to a bearish outlook down to S2. If it stays between S1 and R1 though, failing to break above R1, sideways bias. If it breaks above R1, next target R2, 0.6286. And let's see. Dollar against Canadian dollar. So we've done this already. Done Tesla. We've spoken about ExxonMobil. Support and resistance levels continue to be validated. UBS back up to RS1, 27.26. Aiming for 50 RSI. So bearish sentiment might have waned and is now moving higher. Might fill this gap. ARM still staying between S1 and R1, 114.68, and then 122.45 S1 and R1. So still validating these levels on a 1 hour time frame. Disney moved much higher, might be correcting lower. Coca-Cola staying between S1 and R1. Note this box, this rectangular box that we had placed. So staying between S1 and R1. Sideways bias for company. Let's see, we have forgotten something. We've done them all. We've done gold as well. I placed more of an emphasis on the FOMC's meeting minutes, so anything done could easily be changed after the release of those minutes. Personally, we expect them to be hawkish, which could provide some support for the US dollar. But as you can see, the technicals appear to be bullish for the euro, slightly for the JPY sideways. Slightly bullish for the British pound, whereas weakening for the loonie. So some disparity. Gold is moving higher, so correlated to the US dollar. Weakening US dollar. Wouldn't say so. Perhaps gold strengthening due to tensions, essentially geopolitical tensions. Euros USD, the one to watch. In addition to Nvidia on the daily chart, which is going to be very interesting with their earnings. I think it's a make or break for the Nasdaq. If Nvidia does not exceed market expectations or just barely exceeds them, well, nah, if it does exceed them, then yes, bullish, so that's fine. But if it does come in lower than expected, it could potentially weigh on the US stock markets overall. Might be cause for concern. So we've done Tesla. Tesla continues. The issue is the Cybertruck was released, and then within 2 days, spots are appearing that look like corrosion, according to one of their chief engineers, if I'm not mistaken. It's something to do with the particles in the air meeting the body of the Cybertruck. A recommended solution was cleaning your car once a week. But if I'm buying a brand new truck, I wouldn't want to be told to have to clean it, otherwise it might look like rust. So that could potentially weigh in the company stock price if those issues continue to persist. And then I think that's essentially it for today. There's the knock downwards, actually double top. This could be S1. Or let's just place this one here. I would maintain a bearish outlook. Look, it's broken below. So double top. This could have been, let's say, a neckline. Plunge below. If it comes back down below, bearish outlook, aim for S1. Taking then S2, then S3, 10.06. So this I wouldn't actually place as a support level, but a temporary one. Then R3. This week higher. 10.72 for R3. Actually, nice formation being formed. Has to break below S1. Clear break. So closing below. Aim S2, then S3. Double top. Bearish outlook for the particular pair. And with that, that does it for today. Thank you for watching, and I'll see you next time.
Hello everyone, my name is Emily and welcome to another of our great educational trading videos. Today we're going to look at day trading. Day trading is a very popular short-term trading strategy that involves the buying and selling of financial instruments during the trading day in order to make a profit from small price movements. The most important rule of day trading is that traders need to close out all their positions at the end of the trading day. Generally, the day trader aims to take small profits that can add up during the day or trading period, while at the same time minimizing their losses. While day trading is a viable trading strategy for many experienced forex traders, beginner traders could find day trading to be challenging. Without a well-defined trading plan and the discipline to adhere to its rules, beginners might be overwhelmed by the stress of intraday trading. Day trading strategies can differ from longer-term trading strategies as they focus more on profiting from shorter-term movements in the market compared to moves that take place over a number of days or weeks. In this respect, day traders need to be continuously focused as markets can move suddenly in the short term. Overall, advantages of day trading include instant results and no overnight risk. On the other hand, the disadvantages include requiring a high initial deposit to make substantial profits, less time to think, and there is also a risk of overtrading. Thank you so much for watching us today, guys. Bye-bye.
All right. Okay. Before we kick things off, let's quickly go through the risk warning and disclaimer as well. Do take note that all the products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. Right? These products may not be suitable for everyone, and you should ensure that you understand the risk involved. All right. Do take note of the disclaimer as well. The information in this webinar should not be considered investment advice or investment recommendation, but instead educational material only. All right, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so today's webinar series will be the first part of the Fibonacci series. So we'll be looking at retracements. So we'll start off with the basics. Of course, we'll look at how do we identify an ideal market structure? How is it different from something that's non-ideal? Why is that important? Because when we are trying to use the Fibonacci retracement tool, we should be looking for ideal market structure or something that resembles as closely as possible to an ideal market, right? Being the real life world, nothing's ever ideal when it comes to market structure or price action, but we are going to look for something that's going to be as close as possible to the ideal structure. Then we will look at how we can follow the market structure so as to achieve good or to achieve significant Fibonacci retracement levels, right? When we do not use the Fibonacci retracement tool correctly, and when we do not follow the market structure as closely as possible, then the retracement levels that are highlighted by the Fibonacci retracement tool will not indicate significant resistance or support levels, right? So that's the basics. We are going to identify what is an ideal market structure, what type of price structure in reality mimics the ideal market structure, and then how to follow that, and how do we draw the Fibonacci retracement from the starting point to the end point. Then we'll also look at the various Fibonacci retracement levels. Then we'll also touch on the negative Fibonacci levels as well as the levels that are greater than 100%. All right, so if you have any questions along the way, do not hesitate to drop your questions in the Q&A box or the chat box. I'll be more than happy to go through your questions should there be any doubts along the way. All right, so let's start off with the ideal market structure. What is an ideal market structure? Well, first of all, we'll start off by looking at what is wrong, right? Okay, so when we are trying to draw a Fibonacci retracement, we're looking for significant swings, right? So we're looking for market swings, so like a swing high or a swing low, right? In this example here, what we are seeing, this GIF is showing us an example of insignificant swings, right? So you can see here, I'll just label it, this is number 1, this is number 2, right? So swings like these are pretty insignificant, right? And also here, looking at here, 3, this is a swing high, 4 and 5, right? When you look at 1, 2, or even this one here, let's label this 6. You can see this swings, all these swing highs here, these are the highs, they're all pretty insignificant. So we're not looking for these sort of insignificant swing highs, right? Similarly, when we look for the swing lows, you look here, A, B, C, D, right? These are insignificant swing lows, right? So we're not looking for this type of market structure where the swing highs and swing lows are insignificant. This is pretty noisy, right? To a certain extent. So what we're looking for in a market structure that will have significant swings. Now, this can be swing highs and swing lows, of course, right? So now that we've had an example of what is or what are insignificant swings, let's move on and try and see how do significant swings actually look like, right? Okay, now here we have a GIF showing us examples of how to identify significant swing highs and significant swing lows, right? As you can see here, we need to look for significant swing highs and lows. So clearly we can see here, point number 1 is a significant swing high. Point number 2 here is a significant swing low. Point 3 is another significant swing high. Point 4 is another significant swing low. Point 5 is a high. 6 is a low. 7 is another high, right? So this GIF is clearly illustrating how do we identify significant swing highs and lows in market structure, right? So you can clearly see this is a swing high here, 0.1. This is a low, high. Number 4 is a low, 5 is a high again, 6 is another low, and 7 is a high, right? So do take note. This is how, this is the type of market structure that we're typically looking for when we're trying to identify swing highs and swing lows, because that's very important. That's basically the main foundation of Fibonacci retracements. We need to identify the significant swing highs and swing lows so that when we actually use the retracement tool and we draw the Fibonacci retracements, we are going to get retracement levels that would actually function as, or that would potentially function as very significant resistance or support levels, right? So what we're trying to do is increase the probability of these retracement levels functioning as a significant support or resistance, right? If you don't draw the Fibonacci retracement in the correct manner, the subsequent retracement levels are very likely not to yield any significance, right? Be it as a support or resistance, okay? Right, now how do we follow the market structure, right? Now that we've identified significant swings, highs and lows, now how do we identify, how do we follow the market structure when we use the Fibonacci retracement tool? So as we can see in this GIF here, 0.1 is clearly a significant swing low. That's fine, that's great. 0.2 is also a significant swing high. 0.3 is another significant swing low. And 0.4 is another significant swing high. But in this example, they're drawing the Fibonacci retracement starting from 0.1, but going all the way up to 0.4. As you can see here, the highlighted diagonal line, right? You can see the highlighted diagonal line is going to come up again. Now that highlighted diagonal line in blue, that is the trend line of the Fibonacci retracement tool, right? Fibonacci retracement tool. So when we start a Fibonacci retracement, we always start from the left to the right. So when we're doing it for the upward part of the move, we're always going from bottom left to top right. Similarly, when we draw the Fibonacci retracement for the downward move, we're going to go from top left to bottom right. So do take note, This is another key aspect of how to use the Fibonacci retracement tool. We always go from left to right. So if it's an uptrend, if market structure is going up, right, we always go from point 1 on the bottom left to point 2 on the top right. Similarly, when we have a market structure that's showing a strong downturn, we're going to go from point 3 to point 4. That means we're going to go from top left to bottom right. Remember, Fibonacci is always left to right. Yeah. Whenever we are drawing the Fibonacci retracement tool, be it for the upward move or the downward move, we always go from left to right. So for the upward move, for the uptrend, we're going to go from bottom left to top right. And for the downtrend, we're going to go from top left to bottom right. Okay, that's another key aspect of using the Fibonacci retracement tool. All right, now going back to that trend line, remember I was talking about that can you see here this highlighted in blue, this trend line? Now in this example, they've started this Fibonacci retracement starting from point 1 and ending it at point 4. We can clearly see that the trend line is not capturing the market structure at all, right? We can see that there's plenty of gaps to the top of the trend line as well as to the bottom of the trend line. So in this type of market structure, the ideal Fibonacci retracement, right, to be drawn would be from point 1 to point 2. So when we draw it from point 1 to point 2, we can see that the trend line will capture the market structure much better than from point 1 to point 4. Similarly, when we're doing it for the downtrend, we'll start from point 2 to point 3. And when we do that, the trend line will capture the market structure very closely. So that's what we're looking for. We're looking for the trend line to capture the market structure as closely as possible, be it to the upside or to the downside. So that's how we know whether we've drawn the Fibonacci retracement using the correct starting and ending points. Do take note, if the trend line does not capture the market structure very well, that means it's quite likely we have not used the ideal starting and end points for the Fibonacci retracement, right? Okay, let's go on to the next slide. Now here, we can see we've identified point 1 and point 2. Point 1 is the starting point. Point 2 is ending point. And you can clearly see that the blue trend line has captured the market structure as closely as possible. Of course, there are going to be a little bit of gaps to the downside and to the up of the trend line, but in general, we can see that this trend line has captured the market structure very well. Now, similarly, if we had drawn the Fibonacci retracement from point 0 to point 1 here, right, we would have seen that the trend line would have captured this market structure very well as well, right? Would have captured this market structure pretty well, right? So this is what we are trying to emphasize and highlight. So be it for an uptrend or a downtrend, Fibonacci retracements, we always go from left to right. For the uptrend, so bottom left to top right. And for the downtrend, we start the retracement from the top left, and we end at the bottom right. Right, and the other aspect to take note of, or the important point to take note of, is the trend line must capture the market structure as closely as possible, be it to the downside or to the upside. All right, great. Okay, let's move on to the next slide. All right, so now that we've had a quick look of how to identify ideal market structure, how to identify significant swing highs and swing lows, and also we've also seen how to draw the Fibonacci retracement in a manner that is going to give us significant retracement levels, right? We have to identify significant swing lows here. You can see point 0 is a significant swing low, point 1 is a significant swing high, and point 2 is another significant swing low. And similarly, when we choose the most ideal starting and end points, the blue trend line is very likely going to capture the market structure very closely, right? So do take note of that. All right, okay, with that, now we're going to look at the various Fibonacci retracement levels. Okay, for those of you who may be aware or have used the Fibonacci retracement tool before, so we know that this goes from 0 to 100, right? 0 to 100%. Right, so the retracement levels as highlighted here, as you can see, or well, not highlighted, but as described in this image, you can see that the retracement levels run from 0% to 100%, right? So the key retracement levels are at 23%, 38.2%, 50%, the golden ratio of 61.8%, and the 78.6%. So there's 1, 2, 3, 4, 5 key retracement levels, right? So when we talk about the Fibonacci retracement levels, we're talking about the 5 key retracement levels running from 0 to 100, and they are, right, 23%, 23.6% to be precise, right? 38.2%, 50%, 61.8, which is the golden ratio, of course, and we end up with 78.6%, right? So do take note, these are the 5 key retracement levels: 1, 2, 3, 4, 5. 23.6%, 38.2%, 50%, the golden ratio 61.8%, and of course the 78.6%. Now, in this example, we have started this retracement from point 1, the starting point 1, right? And the ending point 2. So do take note, Fibonacci retrace, the starting point of the Fibonacci retracement will always indicate 100%, and the ending point will indicate 0%. So conversely, if I were to draw the Fibonacci retracement from this part here, let's just identify this swing low as 0.4. Now, let me just tidy this up a little bit. Right, let's just identify this swing low as 0.3 and this swing high as 0.4. So when I draw the Fibonacci retracement starting from 0.3 to 0.4, my starting point is going to show me 100%, and the ending point is going to show me 0%, right? Just like how we see here on this downtrend, right? On the downtrend, we start from top left and we end at bottom right. Conversely, for the uptrend, we start at bottom left and we end at the top right. So starting point is always 100% and ending point is 0%, right? And the key retracement levels, like I said, are the 5 key retracement levels at 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Now, in this example, we're also showing Fibonacci levels that are greater than 100% and lower than 0%, right? So the negative retracement levels are the key retracement levels at the negative point are negative 27.2 and negative 61.8%. We'll touch on this a little later. Similarly, extension levels that are greater, Fibonacci levels that are greater than 100%, the key levels are at 127.2% as seen here, and what is not seen is at 161.8. But for now, let's just focus on the retracements, right? So 23 to 78.6, right? So as I mentioned, we started at 0.1. We started this retracement, right? We started this retracement at 0.1, 100%, and we end at 0.2, which is 0%, right? So we can only start this once the price has formed the swing low. So basically, we're waiting for price to make this significant swing low here, come up here, maybe the first after the first 1 or 2 candles or 3 candles, depending on your time frame. Let's just assume we are on the 4-hour time frame and we see 2-3 candles, at least 1 or 2 candles being formed after we see the significant swing low. That's when we can draw the retracement. So in this case, we're drawing the retracement from 0.1 to 0.2, and what the subsequent retracement levels at 23, 38, 50, 61, and 78.6, what these levels are going to highlight. These levels are what these levels are going to highlight are potential resistance levels. Do take note, when we draw the Fibonacci retracement for a downtrend like this, the subsequent retracement levels are going to help us identify potential resistance levels. All right. Conversely, when we draw the Fibonacci retracement for the uptrend, right, we're going to start from 100% and at 0. What the subsequent retracement levels tells us is going to highlight to us is our potential support levels, right? So we get 23.6%, 38.2%, 50%. So for the uptrend, the retracement levels are going to highlight potential support levels. And for the downtrend, the retracement levels are going to highlight potential resistance levels. Okay. Right. So as you can see here in this example, 23.6% didn't offer much resistance, right? You could see price just stalling briefly here before going higher, where it does seem to have run into resistance. Okay, then after that 38.2%, we can clearly see price breaking above 38.2% as well. Where price failed to break above is at the 50% retracement, right? Clearly, we can see here price has failed to break above the 50% retracement. So this is a major resistance for price for this current example. So we can see just because we have a retracement level at 23.6% and 38.2% does not mean that price is going to stall at this level and reverse and drop lower, right? They are just points that are going to help us identify potential, right? What is important here, they are highlighting potential resistance levels. It doesn't mean that they will act as significant resistance levels, but what the retracement levels here are going to highlight is they are highlighting potential resistance levels. But in this example, you can clearly see 23.6% and 38.2% did not offer any major significant resistance. Where price did stall was under the 50%. So now we know for that 50% is a significant resistance level and is going to take something pretty like a strong catalyst for price to break above this level. All right, so do take note. The retracement levels highlight potential support or resistance. They do not indicate or they do not guarantee that these retracement levels are going to function as very significant support or resistances, right? Do take note. That's a very important, another important aspect of using the Fibonacci retracement tool. All right, okay. Moving on. All right. As I mentioned, the key retracement levels are 23, 38, 50, 61, and 78. Levels that are lower than 0. We also have Fibonacci levels that are lower than 0%. And we have Fibonacci levels that are higher than 100%. So we're going to get to those as well. All right, so the negative Fibonacci levels, right? So the negative Fibonacci levels are also known as expansion levels. You can see the key negative Fibonacci levels are negative 27% and negative 61.8%, right? These negative levels are also known as expansion levels, all right? So you may hear or come across this term, so do not be confused if you come across the term Fibonacci expansion or expansion levels, right? They simply refer to the negative retracement negative levels, which are at negative 27.2 and negative 61.8. All right. Okay. So these are the key retracement levels for the negative at the negative end, and they are also known as expansion levels. Now, how can we use this? Okay. How can we use these expansion levels? Well, first, right, you can see we started this retracement from point 1 here, and we ended at point 2, right? And we can also see 50% is here. So in order to use the negative levels, or not rather to use, but for the negative levels to provide or to function as significant support levels, we actually need to see price retrace up to at least 50 to 61.8%, right? Do take note, price must retrace, right? After forming this low here, this significant swing low here, price must retrace to at least 50% or even better, 61.8%, so that when we see a market structure like this, and then should price reverse and drop lower, breaking under the 0% or the ending point, that means that these negative levels are expansion levels at negative 27.2 and negative 61.8% Fibonacci are going to potentially function as significant support levels, right? So do take note, this is another key aspect when using the expansion levels. The Fibonacci, the market structure must retrace up to 50 to 61.8%. It must, right? So at least 50%, and then should price reverse and drop lower, breaking under the ending point, that means negative 27.2 and negative 61.8 are going to potentially function as significant support levels. Okay, this is a very important aspect, because if price only retraces up to 38.2% and then stalls and reverses to drop lower, that means this levels here at negative 27, negative 61 may not offer significant support, right? Do take note. This is one key criteria, right? The key criteria is the retracement has to come up to at least 50%, right? The retracement has to come up to at least 50%. I'm talking about this retracement here, right? It has to retrace up to at least 50%, even better if it comes all the way up to 61.8. And then as it reverses to drop lower, the expansion levels are then likely to function as significant support. All right. Okay. Now, in this example, we can see clearly that price has retraced to 50 and has even reached 61.8%, right? And then has now started to reverse and drop lower. Now, so how can we use these expansion levels? First off, as price starts to retrace to drop lower, we can also use the 0%, for example, as a potential take profit level, right? As so if you go short on this position here and price is reversing, right? Perhaps there's a strong bearish catalyst that has a combination of a strong bearish catalyst, and your technical analysis is telling you this is now a potential short entry where you would identify your take profit would be potentially here at the major swing low here at 0%. And should price continue to break lower, you can identify your second TP or take profit at the negative 27.2%. So, right, this is where we can this is how we can use the negative Fibonacci levels or the expansion levels to help us identify potential take profit levels for the short side, right? So in this example, you're seeing it for the short side, for a potential short trade, right? So typically, in this scenario, price will, if price breaks below this swing low here, it will typically find support at negative 27.2%. And usually it does bounce off this level to return to 0%. So do take note. So this is how we can use the negative 27.2% Fibonacci expansion level to help us identify a potential take profit on the short side or for the potential short trade, right? Okay. With that, okay, now we're going to look at Fibonacci levels that are greater than 100%, right? The key Fibonacci levels that are greater than that are greater than 100%, as I mentioned earlier, at 161.8 and also at 127.2%, right? These are the two key significant retracement levels. Extent levels that are greater than 100, and these levels that are greater than 100, they're also known as Fibonacci extensions. All right, do take note. Right, so if you come across the term Fibonacci extension levels, it is simply referring to levels that are greater than 100%, and they're specifically referring to 127.2% and 161.8%, right? Just like for the Fibonacci expansion levels. So similarly, if you come across the term Fibonacci expansion levels, they're referring to levels that are the negative levels, and specifically referring to negative 37.2 and negative 61.8. Okay, so expansion levels are negative, also known as the negative Fibonacci levels, also known as Fibonacci expansion levels, and the Fibonacci levels that are greater than 100% are also known as the extension levels. And the key extension levels come in at 127.2 and 161.8%. All right, so in this example here, right, we see price from this starting point here, point 1 making the swing high here, and then point 2 has made the swing low here. So how we can use the extension levels is we can use these extension levels to help us identify the take profit, a potential take profit zones. Sorry. So in this case, you can see price has made this Nike tick structure. You can see this Nike tick structure, right? We all know the company Nike and its logo, which is the tick. And you can also clearly see a price, this market structure here. is following this Nike tick structure. So what we see is, or how we can use the extension levels is when we see price reverse strongly and come back up to the starting point, which is at 100%. Here we can say we're looking for potential bullish breakout here, right? We have our technical indicators telling us that this is a strong bullish move. We also have a strong fundamental data catalyst that's driving this move as well. So we are looking for potential bullish breakout. So when price breaks above 100% here, how we can use the extension levels is we can use them to identify potential take profit. So for example, 161 here has been identified here, and 127 is probably somewhere around here. So we can use these extension levels to identify potential take profit. So this could be the second take profit zone, whereas the 127.2% would be the first take profit zone, right? So this is how we can use the extension levels to help us identify potential take profit zones should price break above the 100% or the starting point and continue to drive higher. And then from here is where you could potentially is to identify a major resistance level. And from here, you could also potentially initiate a short trade idea as well. Because when you see price failing to break above the 161.8% extension level, it is quite likely it is going to drop lower. So as price moves away from this extension level and starts to drop lower, you can initiate a short entry, and your stop loss will be placed slightly above the 161.8% Fibonacci retracement to give us a little bit of a buffer, right? To give us a little buffer. So should price retrace back to the 161% as you can see here, but because we've kept our stop loss slightly above the extension level at 161%, it allows us to remain in the trade, and should price continue to drop lower, we can benefit from this potential short trade idea as well. So you can see how the extension levels can be used to identify potential take profit zones to the upside. And then once it hits 161.8% Fibonacci retracement extension, and then it starts to pull away, you can also consider initiating a short trade idea where you put the stop loss slightly above the 161.8% Fibonacci extension. All right. Okay, great. Let's see. Right, okay. We've come to the end in terms of my slides. So what are we going to do? What we are going to do now is we are going to move over to trading view and try and find examples of how to use the Fibonacci retracement tool correctly, right? So we're going to start, of course, just start off with the basics. All right. Okay. So here I am on trading view. I'm on the 4-hour time frame, and I'm going to use the dollar index as an example, right? So first of all, we're going to try and identify significant swing highs and swing lows. So let's just do this exercise together, right? So just to take note, when we are using Fibonacci retracement tools, they generally work better on the higher time frames, right? So they generally work better on the 1-hour time frame and above, right? You can use them on the lower time frames as well, 30 minutes, 15 minutes, but they may not offer the same level of support or resistances as when we use them on the higher time frames. So do take note about this aspect of using Fibonacci retracements, right? They do tend to work better on the higher time frames, such as 1 hour and above. All right. Okay, so first of all, we do a simple exercise on trying to identify significant swings, right? As we saw in the slides earlier, right? We saw examples of insignificant swings, and now we're going to look at examples of significant swings. So this is I'm on a 4-hour time frame for the dollar index, DXY. My chart is showing the price structure from end of September all the way to present time. So I think it's quite clear by now where the significant swing lows and swing highs, right? So, right, you can see here this is a significant swing low here. Okay, maybe hang on. Right, let's start off with swing highs. We can see this is a significant swing high. This is also another significant swing high here. This is another significant swing high. This is another high. This as well. this as well here, right? So 1, 2, 3, 4, 5, 6, right? These are generally how we would identify significant swing highs, as this one here as well. So the red circles are, I'm highlighting the significant swing highs in red, and now I'm going to highlight the significant uh swing lows in green. So you can see here, this is a significant swing low. This is another swing low here as well. Here, 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 and of course here, right? So what we're actually trying to look for, right, is I'm going to now just use a different color. So we're going to look for significant swings, right? So you can see when price makes a very strong V-shaped move here like this, as highlighted in the orange line, right? We can see that this is a very significant V-shaped move, right? And this tells us this is a significant swing low, and this is a significant move. Similarly, right, when I draw the swing high from here, we can see this is an inverted V shape, right? We can see a very clear, significant swing high with a strong inverted V shape as well. Similarly, for this downside, we see a strong V shape here. And then for this swing high here, we can see generally the pattern that I'm trying to get at. You can see that this is another inverted V. Similarly here, this is a strong V shape pattern here, swing, another strong inverted V shape here, another strong inverted V shape here, strong V-shaped pattern here to signify the significant swing low. Another one here, inverted V-shape to indicate the swing high. Another strong V-shaped pattern here to indicate the swing low. And this high here, low here, high here as well. This is also a pretty significant swing low bounce here. And of course, this significant swing low over here. Right, so you can clearly see how we can identify major swing highs and swing lows, right? That's important, right? So as you can see here, I'm just going to leave this on for a bit before I erase it. So you can clearly see the green circles highlighting the significant swing lows, whereas the red circles are highlighting the significant swing highs. And you can see by my orange V shapes as well. We see an inverted V shape as well as the regular V shape that show us the size of the move, right? We're looking for significant swings and lows and highs, and the size of the move can be is highlighted by my orange brushes, right? You can see that the moves are very significant. So this is how we identify swing highs and swing lows, so that we are able to identify ideal starting and ending points for the Fibonacci retracement, right? Okay, so now I'm going to clear all of this, and I'm going to show you how we can draw the Fibonacci retracement for these on these swing highs and swing lows. All right, so we'll start with here on 29th of September and we'll end here on 3rd of October. Okay, so for those who may not be familiar with the Fibonacci retracement tool, the icon looks something like this, right? So you'll see 4 lines and you'll have the bubble here as well, the circle here on the left and on the right. So if you highlight it, it'll show you depending on whatever platform you're using. But if you're using a trading view, right, if you highlight over this icon here, it'll tell you Fibonacci retracement. So that's what you want to use. So we click on that, and we're going to start with the absolute low point here. Okay, so I'm just going to zoom in a little bit. Right, so I'm going to just zoom in a little bit. This is my starting point, right? So remember, for this is an uptrend, so Fibonacci retracement always goes from left to right. Since this is an uptrend, we're going to start from the bottom left and we'll end at the top right. Okay, I'm going to pull up all the Fibonacci levels here. So this gives me the negative levels, the positive levels. Remember, negative levels are called expansion levels, and levels greater than 100 are called extension levels. Okay, right? Okay, but with that, I'm just going to focus on the retracement levels in this example, right? So as not to overcomplicate things. So I'm going to get rid of the extension levels as well as the expansion levels, right? And we're just going to deal with the retracement levels going from 0 to 100%, right? So then this is much more clear. So when we draw the Fibonacci retracement from this uptrend here, bottom left to top right, and as price is coming down, these retracement levels are going to potentially are going to highlight potential support levels, right? Now, whether these levels truly function as significant support levels, we can only tell when uh, the move plays out. But generally, it does help us to identify potential support areas. So as price has made this swing high here and started to come down, we can see that price did find decent support at a 23.6%, retracing higher before falling lower. Then again, you can see here, it did find a little briefly found support here at 38.2%, again at 50, then also pretty strong support here, 61.8%, 78, and then finally 100 down here, right? So you can see clearly in this example here, price did seem to find support at almost nearly every single retracement level. Now, this doesn't always happen to be the case, right? There, as we saw in the slides, right, there can be cases where price will just simply break through the 23, 38, maybe even the 50, and then find support at the 61.8%. So do take note, in this example here, we do see price to have clearly found support at each of the retracement levels, right? Okay, this was an example for the uptrend. Now I'm going to draw a Fibonacci retracement for the downtrend, right? So this was the uptrend, bottom left to top right. We can clearly see here, this is a strong move down. We have a nice significant swing high here on 3rd of October, and we have a significant swing low here on the 12th of October, right? So we're going to start this retracement from here. Remember, whether it's an uptrend or downtrend, we always go from left to right. So since this is a downtrend, we'll start from, hang on. We'll start from the top left and we'll end down here on the bottom right. So in this example, we can clearly see price has broken through 23, 38, and 50% very easily, right? Very easily. These retracement levels here did not offer a hint of resistance at all. Where it did finally run into resistance was at 61.8%, right? And then after that, over the next half a day or so, price briefly broke above the 61.8 as well before dropping lower. So you can see where price found major resistance in this example is at the 61.8%. Do remember over here when we did the Fibonacci retracement on this uptrend here, we could see price finding support at every single retracement level. However, for this part of the move, we can see where the only level that offered serious resistance was at the 61.8% Fibonacci, right? So you can clearly see no two Fibonacci retracement is going to behave the same way, right? We are never going to see the same retracement levels functioning as a major support or resistance, right? Every swing high and swing low, every uptrend and downtrend is going to be different, right? So do take note of that. There's nothing set in stone with regards to the Fibonacci retracement levels. It could be a case where the retracement levels offer support or resistance at every single level, or there could be a case like what we're currently seeing, where only the 61.8% has offered significant resistance. All right. Okay. So here we can see the price running into resistance 61.8 on 12th of October, 13th of October, as well as 19th of October, right? Okay, so these were the two examples of how we can use how we can draw the Fibonacci retracement for an uptrend and downtrend. All right. Okay. Now let's move over to somewhere to where price is currently trading. Right. Let's see where price is currently trading and perform some technical analysis here using the Fibonacci retracements. All right. Okay. So once again, before we try and draw the retracements, let's do a simple exercise where we can try and identify the significant swings, right? Okay, so this is a green. All right. So we can see here, this is a pretty significant swing low here on 29th of November. Another significant swing low here on 15th of December. This significant swing low here on 28th of December. So when we look at end November till now, we can see 3 significant swing lows when we're on the 4-hour time frame. All right. Okay, now I'm going to try and identify significant swing highs. Right. You can see here, this portion here is a pretty significant swing high here. And over here, okay, price has not yet played out, but you can generally see the top of this wick is another significant swing high as well, right? Okay, so let's just say, okay, let me just, okay, I'm just gonna highlight my points so it's easy to refer to as well. All right, so let's work with points 1, 2, and 3 first. All right, let's work with the first 3 points. All right, so we have identified our major swing highs and swing lows. So let's just focus on the first 3 points. So for this upward trend here, we would be actually technically we would have highlighted this as 0.2 because as price was pulling down, we have highlighted this as 0.2. So we'll take this in step by step. So we'll start the retracement for this uptrend here from 0.1 to 0.2, right? You can see here in this example, as price was pulling back, 23.6% did not offer any support at all. 38.2 not really, because we can see the wick extending way beyond the 38.2 and even dipping below the 50%. So where it did find support here in this example was around the 50% Fibonacci retracement, right? As we can see here, the body of the candles actually closing underneath the 38.2%. And we can also clearly see the wick extending beyond the 50. So where price did find support in this example was at 50% before going higher. And as price comes up here, right, when a new high is made, we cannot use 0.2, the original 0.2 anymore. If we do wish to use the Fibonacci retracement, we have to move our ending point now because this is a new high. We have to move it to here, which is, yeah. And in this sense, you can see the trend line, right, is capturing the market structure quite well, right? Is not as ideal, as perfect as what we saw here at the first go. You can clearly see the trend line has captured the market structure very well. But even when it makes this second high here, you can see that the trend line has captured the market structure quite well. So we can still use this. So similarly here, 23.6% did not offer any support. Where it did find support was this time round at around the 38.2 before retracing higher and then finally smashing through all the other levels. You can clearly see here as it smashed through 38.2, 50%, 61% offered no support. Where it did find support briefly was at around the 78.6% Fibonacci retracement. All right, you can clearly see how the retracement levels help us to identify potential, right? The key word here is potential support levels or potential resistance levels, right? Nothing is set in stone. It doesn't mean price has to react off each level, but it's just helping us to identify potential support or resistance levels. Okay. Now, after price has come down here, it has found support around 100 and 190 before proceeding higher. So now we have 0.2 and 0.3. We can also run a Fibonacci retracement on this downturn. So we'll start from here, 0.2, 11th of December, going down to 0.3, which is the 14th of December. So in this case here, we can see as price was retracing higher, these retracement levels are helping us to identify potential resistance areas or zones, but we can clearly see 23.6% offered no resistance. Where it did run into resistance was around the 38.2%, right? 38.2% was where price found resistance before dropping lower. And you could see from 18th December all the way till 3rd of Jan, right? This price failed to break above this level until just recently last week. Okay, so this is how we can use the levels here. Now, as price comes down here, right, we can see now this, I would use this as let me highlight this as 0.4, right? So you can see here, this is a pretty significant swing high. This is a significant swing low. So if I were to extend this Fibonacci retracement, right, I go from 2 to 4, right, we can see that the market structure, the trend line has captured the market structure quite well, right, quite well. Some would argue that because this has drifted too far, I would not use 0.2 as a starting point, but rather I would try and use 0.3 here, for example, this point here. Okay, here the market structure, the trend line captures the market structure a little bit better, but even here, I think to me this is still pretty all right, right? This is still pretty all right here. You can see at this part, especially the beginning of the move, the trend line captures the market structure very well, and the second half of the move, it captures it pretty well as well. It's only this bit here. So as price is retracing higher, we can see clearly 23.6, 38.2, and 50% retracement levels offered no resistance at all. Where it did run into resistance was around the 61.8% Fibonacci retracement, right? So you can see here, these retracement levels are just going to help us identify potential resistance, but you actually have to see where price is actually going to run into, right? So you can see here, because this is also an overlap, a pretty strong resistance level here, right? As price retrace higher here in 18 December, this forms a pullback resistance, right? This forms a pullback resistance level. And you can see price actually running into resistance here on 3rd of Jan, right? It broke above 23, 38, and 50 very easily, but it actually stalled at around this resistance level here at 102.64. And also we can see how the 61.8% Fibonacci retracement has also helped us to identify another strong resistance zone above this pullback resistance. Okay. And now, okay, I'm going to label this as 0.5. So in this case, I'm going to run the Fibonacci retracement from 0.4, this swing low, ending with this high here at 0.5. Now, as price is let me get rid of this. Right, now as price climbed as high as or briefly going above 103 and then pulling back sharply, you can see that as it was falling down, 23.6% offered no resistance. 38.2 is a level where we did find a little bit of resistance, right? But actually, you can see it actually go beyond. So where it found support was slightly above 50%, right? So the major support for the dollar index now is actually at around 102.10. And we can also see that 50% is also still suggesting another strong support zone should price break underneath 102.10, right? So do take note, these are the key support and resistance levels of course, now with price breaking above it, I would have to adjust my resistance to this level here. I'm going to use the body of the candle so we can see the major resistance at 102.74 and major support at 102.10. All right. So so we've covered Fibonacci retracements today, which is part 1 of the Fibonacci series, masterclass series. Right. So do look out for part 2 coming up next week. Right. So where we will be building on retracements. Right. We covered a little bit of extensions and Fibonacci expansions today as well. Do take note, expansions are the negative levels and extensions are the levels greater than 100. We covered a little bit of that as well. And in part 2, we're going to delve a little bit more deeper into them. All right. So just to recap, today we had Fibonacci retracements. Do remember we're looking out for significant swing highs and swing lows, right? Such as these, right? We're looking out for significant swing highs and lows. Where did it go? Where's my brush? Right. Such as these, right? This is a significant swing low. This is a significant swing high. Another significant swing low. also another significant swing low and swing high. So do take note, it is important to identify a good or ideal market structure where we can clearly see the significant swing lows and the significant swing highs, so that when we draw the Fibonacci retracement tool, we're actually going to get uh, uh, indication that these retracement levels are going to offer uh, significant support or resistance. And do take note that the trend line has to capture the market structure as closely as possible. All right. Okay. So we've come to the end of today's webinar. Thank you all for tuning in. Do look out for next week's Fibonacci series part 2, right? And do register for that as well. All right. Take care. Have a great trading week and enjoy your weekend as well. All right. Thank you, everyone. And I'll see you guys next week. All right. Take care.